What if you could significantly increase your cash flow by extracting much more out of your dividend yielding stocks? In this video, we're going to be teaching you just that, how to do that. I'm Seth Freiberg, and we're one of the top proprietary trading firms in the world with numerous 7- and even 8-figure per year traders. So you found the right place to learn. One of the most common reasons that people trade options is to produce extra cash income for themselves each month. And this fact is not lost on professional traders here at SMB, some of whom use option strategies to produce significant cash income for their accounts in addition to their other trading activities. And this is especially interesting to investors who count on dividends from their investments to create cash flow for themselves. The problem, of course, is that dividend returns are often really low. In fact, the average dividend yield of the S&P 500 is barely over 1%. But even if you own higher dividend yielding stocks and ETFs, which can frequently yield, say, 3 or 4% or even more sometimes, that's just not going to cut it in terms of income needs for traders in most cases, where honestly, they can get the same yields by investing in a bank CD and not taking any equity risk. And so for someone who doesn't mind the risk of owning equities, but absolutely can't tolerate accepting the tiny dividend yields generally available to equity investors, what's the solution? Well, there is a solution, and that's what today's video is about: how to substantially boost the cash returns of the stocks or ETFs that you own. Now, before we get into this important topic more deeply, if you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so with that said, let's jump into the option strategy I've been alluding to, which will substantially boost the income you can earn from dividend-paying stocks. So let's take a look at a chart of the iShares 20-year Treasury Bond ETF, known as TLT, which is basically a proxy for the long-term U.S. Treasury bond market. And as you can see, with the uncertainty around the direction of inflation and therefore Fed policy, the ETF has been selling off steadily since September of 2024. And by the first trading day of 2025, January 2nd, the ETF closed at 87.57, well off its highs back in September. Now, TLT pays its dividend monthly, which is much more frequent than the typical stock. And around the beginning of the year, the annualized dividend yield of TLT was a little bit above 4%, which means that it was paying a dividend in the neighborhood of 30 cents a share each month. And so let's say that on that day, at the end of the day, we bought 1,000 shares of TLT for that $87.57 price, spending $87,570. And we also pulled up an options chain expiring about a month later on February 7th, and we looked for a call option with a strike price just above where the stock was trading, which were those 88 calls. And we went ahead and sold 10 of them because we bought 1,000 shares of the stock, and each call option represents rights related to 100 shares of stock. So we sell 10 of them, and that represents 1,000 shares of the stock we own. So that if the stock closes above the strike price of that call, which is 88 in this case, then we'll have the shares in our account to fulfill that obligation. And so when we do that, when we buy shares of stock and sell calls against those shares, when we do that, we are entering into what options traders refer to as a covered call, which is a powerful option strategy for increasing the returns from your equity portfolio. And so as a result of selling those 10 calls for that price of $1.53, you'd collect in cash from that sale $1,530 because each option relates to 100 shares of stock. So you multiply that price by 100 and you sold 10 of them. So that comes to that $1,530 in cash flow that will be immediately reflected in an increase in the cash balance of your account. Okay, so now let's move to the day that these call options expire, which is February 7th. And as you can see, on that day, the stock closed at $89.27, which in this case is above the call strike price. And so in order to avoid having our shares called away, because the owner of those calls will definitely exercise the calls so they can buy the shares for $88 when the stock is trading at $1.27 higher than that at $89.27. So to avoid that, we go ahead and pay the price of $1.27 and close that call position before it gets assigned. And so when we calculate the result of this first covered call trade, you'll see that after collecting $15.30 initially, we net out against that the $12.70 that it cost us to buy back those calls. You can see from the calculation means that our profit on the first trade was $260. Okay, so let's start keeping a scorecard of how this trade's playing out, because we're going to be doing this every month to create cash income for ourselves. And so the first thing that we'll enter onto the scorecard, of course, was that $1,530 we first received. And you'll also note that the day before the first covered call trade expired, we received our first monthly dividend, which was a 31-cent dividend, resulting in an additional cash flow of $310. But then the next day on February 7th, we paid out $12.70 to close the call position, meaning that so far our overall positive cash flow from our TLT share ownership is $570. Okay, so at this point, we will continue our campaign by selling the next month's covered call, moving out a month to March 7th. And as you can see in this case, the calls with the strike price right above where the stock closed at $89.27, the 90 March 70th calls were trading for $1.10. And so that's going to produce $1,100 of positive cash flow. Now, moving forward to the day this second trade expired on March 7th, as you can see, TLT staged a mild rally, closing at 90.11 on the day the March 7th covered call trade expired. And so again, to avoid those 90 calls being exercised, losing our shares, we instead buy those back for that 13-cent price that you can see on the options chain. And so updating our scorecard, accounting for the dividend paid of $290 on March 6th, and after deducting $130 that we had to spend to buy back those calls at 13 cents from the cash flow we initially received, selling those calls, our positive cash flow on this options trade is now $1,830 for the entire campaign. Now, we move on to our April trade, selling the 91 calls, again right above where the stock closed, for a premium of $1.11, resulting this time in positive cash flow of $1,110. But this time, by April 4th, TLT had bounced a bit harder this time, closing at 92.85 on the day it expired. And so buying back those calls is going to be expensive, because with the stock closed at $1.85 above the strike price of the call, those calls are very valuable, conferring on the owner the right to buy those shares for $1.85 less than their trading price. And so we've got to pay $1.87 to close those. And so updating our scorecard and accounting for the 32-cent dividend paid on April 4th, as well as the expensive buyback of the April calls, we took a slight hit to our cash flow, such that after the April trade, our positive cash flow was $1,410. Moving to the May trade, the 93 calls right above where the market is selling are going for $1.81, so we collect $18.10 for those. But this time, something interesting happens, and that is that the stock undergoes a significant sell-off, such that by May 2nd, it closed at 87.73, down about 5 points from the trade entry. And so what that means is that the call options simply expire worthless, because it only has value if the stock closes above the strike price. But this time, the stock closes way below it, resulting in the call just disappearing, and we don't need to buy it back. It just disappears. It just expires with no value. And so this time we have our positive cash flow, but there's no cost of a buyback. That just becomes zero for the options expiration. And we also account for the $330 dividend we received a few days earlier. So our total campaign cash flow is now $35.50. Now the next month's trade, the June 6th expiration, we again sell the calls right above the closing price, which in this case are the 88 calls selling for $1.73, thereby collecting $1,730. But again, As you can see, on the day the June trade expired, the stock closed well below the 88 strike price, closing at 85.35 as that TLT sell-off continued, rendering the 88 June calls with no value at expiration again. And so adding the 1730 of cash flow from the June trade and the 320 dividend, we're now up to $5,600 in total trade positive cash flow. Now, the July trade's interesting because this is the one case where we don't sell the call right above where the stock is trading. Instead, we'll be selling the 88 calls. Now, why the 88 calls? Well, if you remember, the original cost of the shares way back in January were $87.57 per share. And so if we sold the 86 calls, which you might have expected us to do at this point because that would be the first call strike above the closing price of 85.35. If we sold the 86 call and the stock bounced past 86, then those shares would be called away at a price of 86. But we paid $87.57 for those, and so that would lock in a loss on the shares, which is not what we would ever want to do in a covered call campaign. And so instead, we sell calls at the lowest strike price above our purchase price, which is the 88 calls, which we sold for 43 cents, yielding us $430 in cash flow. As you can see, while TLT bounced, it didn't make it to 88, closing at 86.97 on the day these options expired, so those calls close worthless as well. So when you combine the July initial $430 of call premium and the dividend issued on July 7th, the total is now up to $63.60 in total cash flow. And finally, for the most recently completed trade, the August 1 trade, we again select the 88 calls for a price of 94 cents, bringing in $940 for the same reason as we did for the July trade. We don't want to lock in a realized loss on the original shares at a strike price any lower than 88. And so moving forward to August 1st, you can see that the stock again didn't quite make it to 88, closing that day at 87.82. And so again, the calls expire worthless. So to wrap up the trade through the most recent August trade earlier this month, you can see that adding the August call premium to the dividend paid in early August, our total campaign cash flow since the beginning of the year has been $7,630. Comparing that to the dividends only approach, just sitting back and passively collecting dividends, that would have only produced $2,230 in cash. Whereas the covered call program combined with those dividends would have produced $7,630, as we just walked you through, more than triple the income. And yet, this additional income requires really, if you think about it, very little effort for a vastly better return. And so what I'd like you to take away from today's video is that running a covered call program in conjunction with a dividend-paying stock can be an incredibly rewarding practice if you're looking to glean much more cash from your equity portfolio. Professional options traders use this strategy all the time to enhance their account returns, and now you've got the insight into how that's done.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.